Morning, welcome to Trading Hour. It just feels like the day after, right?
Yeah.
Yesterday was the big event, and today markets are consolidating, it's digesting the news, and they're giving up yesterday's gains. We went down to levels of 24,200, pretty much touched yesterday's intraday low. We broke that also, and from there's been a little bit of a recovery. But again, as the screen shows you, it's still deeply in the red. 1% gone on the frontline indices. The Nifty bank was down 1%. Now it's down close to about 0.5%. Mid caps in the red, but again, there's relative outperformance there.
You know, it is one of those days when even a 75-point cut, we are calling it an outperformance because the other indices are seeing a sharper cut today. But point taken, we saw a stellar rally yesterday, and today it's been a cut. And of course, that recovery in the small cap index that you can see right now in the Nifty pack as well, a very mild recovery from the lows, so to say. Most of the sectoral indices, they are in the red. Nifty Metal seeing the biggest cut today. That index is down around 1.5%. You have the likes of Pharma as well. A lot of Pharma earnings that are trickling in, but the index is not doing so well. Nifty Metals, of course, because of that big cut in Hindalco that we are seeing today. The IT pack, which was doing really well yesterday, has come in for some profit booking. So yes, there's profit booking all around, and we continue to see those cuts as well. We'll discuss markets and we'll discuss individual stocks in greater detail, but let's talk about the first corporate on our radar. Hightech Pipes is the first management joining us on the show today. The company reported a good set of earnings with its EBITDA up 63% on a YY basis. To discuss the earnings and the outlook for FY25, we have with us Anish Bansal, the CEO of the company. Mr. Bansal, good morning. Thank you so much for joining in. Well, can you give us a sense of what led to this EBITDA increase? Was there any inventory loss that you saw? Because the peers in the industry did see that. So give us details of that.
Both of you. So yeah, thanks for the results. I think the company did exceedingly well given the circumstances, overall monsoon and the global steel prices. But we could have some good orders especially from the renewable energy side in Q2, and that really helped us in meeting these challenges of Q2. And with our new facility in Sanand, where we are producing all sort of high technology products there, and I think that is giving a good tailwind to overall company. And going forward, I think we will have certainly a very good set of numbers.
But Anish, was there an inventory loss in Q2?
So, we got a support from the steel mills in terms of, rebates. So that was one. Second was, the fixed price orders that we had, that was quite sizable. The company had a big order from the renewable energy side, and that helped us mitigating the inventory losses.
So there was zero inventory loss, or was it set off because of these new orders that you're talking about?
Yes, there was, but then that got compensated by, the...
How much was that? Yeah, that's what we wanted to understand. How much was the inventory loss this quarter?
So 600 to 700 rupees per ton, but that was mitigated.
Okay. Got that. So do you think margins at 6.1% roughly are sustainable? And even for the full year on volumes, are you on track to maintain your guidance of 0.5 million tons?
Yes, absolutely. If you see in H1, we have already done approximately 2.5 lakh tons of sales volume. And H2 is generally, good for the entire sector. And I think, we are on track of achieving 500,000 tons for sure.
Okay. And what about EBITDA per ton? You had spoken to us about 3,800 rupees per ton would be the EBITDA per ton this year. Are you on track to achieve that? And considering that Q2 has been better than what the street was working with as well, will you be able to surpass that figure?
So yeah, 3,500 was, we have done in H1 approximately, and H2 is, generally higher for us. And with the new capacities and new value-added products that are coming up, we are on track of achieving 3,800 rupees per ton on a blended level for the full financial year.
Is there a possibility you will be able to exceed that considering the new fixed price orders?
Let's hope for the best, but then, there are still like a lot of volatilities there. So I'll stick to our previous guidance, and whatever, we do better will be, a bonus.
Okay. But H2 is typically better than H1. So therefore, you should be able to exceed your guidance, not just meet it on the volumes, right?
Yes, absolutely. But then, there are volatilities, but, we are keeping our fingers crossed. So, I think...
What about exports? What percentage of your revenues in the current quarter were exports? Are you seeing any sort of a slowdown there? And what can you guide for the second half of the year in terms of exports?
So currently, our focus is on the domestic market because the maximum tailwind is coming from the domestic side, and our focus currently is on the domestic market. And I think going forward, also for next 1.5 years, our focus and the capacities that are coming up will be focused to meet the domestic demand first. And exports, there is a certain uncertainty over there. The logistic costs are are volatile. So I think exports should happen in next 1.5 years from Hightech Pipes.
So currently exports around 10 to 15%. Will it come down because you're focusing more on the domestic markets?
So currently we are under 5%. I think it should be in that territory only.
Okay. You spoke about how value-added products could aid margins going forward. How do you see your sales mix change towards value-added products in the second half? What is it currently? Because the last time you said it was around 37%. By when does it move to that 50% mark?
So our target is to take it to 50%, and I think that will take about a year and a half or so. The new capacities that are coming up are focused mainly towards the value-added products, which includes galvanized products, solar torque tubes, and certain special SKUs which are direct import substitution. So once this happens, I'm sure the total blended VAPs share will be 50% up, and I think it should take 1.5 years from now.
So by FY27 end, right? It should
Absolutely.
be 50%.
Absolutely. Yes.
So for the value-added products, what is the EBITDA per ton? And by FY27 end, what would the EBITDA per ton of the company look like?
So currently, the value-added products are fetching us a EBITDA per ton of around 5,000 rupees per ton. And if we if we go forward with the new facilities and with the higher scale of operations, I think blended EBITDA per ton can reach 5,000 rupees per ton in next 2 years.
Okay. Let's talk about the QIP. You raised around 500 crore rupees via QIP. What will the impact on finance costs be? Currently, it's around 13 to 14 crores per quarter. How much does it come down by? By when are you using those proceeds?
So currently, we have utilized around 250 crores for debt repayment, and I think that will directly give impact on the interest cost reduction. And but the company, as the company has embarked on a mission to reach 2 million ton capacity in next 2.5 to 3 years. So once this is done, in the long term, the interest cost will remain there will be no incremental working capital or incremental debt. But currently, in this at the end of this financial year, will be net debt free, and there will be certainly a interest cost saving for FY25.
Okay, FY25 net debt free. Thank you very much, Mr. Bansal, for joining in. We'll slip into a very short break. We'll come back and talk commodities. Manisha Gupta joins in as always.
Welcome back. Well, equity markets are under pressure, but what's happening with the commodity space? Manisha Gupta is joining in. Today we are focusing on crude, Manisha. A lot of commentary coming in from Trump as well.
Oh, well, yes, it has been very, very volatile the last 24 hours when you look at the crude oil prices. And while we did see prices trying to come above $75 early in the Asian markets, but that's not the case right now. Oh, we are back around that. So that's exactly what I'm talking about. It has been very volatile. The range that we've seen for the day today has been 74.2 to 75.5 on the higher side. Well, a couple of things really. One, there's an expectation of fiscal spending and then tax cuts as well come in US, as Trump has been saying. And then there are concerns on trade tariffs, on on China. China, remember, is still the largest consumer of crude oil. So the kind of reactions that we could come from there is something to see for. Having said that, China seems to be fast moving away from crude oil into EVs, batteries and electrical. So in that sense, the crude oil demand has been declining, even if by a small margin, but it has been going down. The third thing really is that as Trump comes back, there are expectations that you could be looking at sanctions coming back on Iran, on Venezuela and such more conversations. Brent crude prices have continued to be volatile. We've seen prices trade between this year until now at a range of 68 on the lower side to 91 on the higher side. But for most part of last quarter and so, it has continued to trade below 80. We have seen 17% of decline in the previous quarter for the crude prices as well. IEA also says that the U.S. inventories have gained by nearly 2.1 million barrels. The U.S. crude production in the month of August and September has been at a record 13 million barrels. So all of those factors continue to be bearish for the prices. Having said that, it is the U.S. Fed meeting today and China stimulus. So the next 2 days continue to be very eventful, and that's exactly where the markets will take cues from.
Thank you very much for that. We will slip into a very short break on that note. We'll come back and touch base with the management of Teamlease. The stock is down close to about 6%. On a year-on-year basis, we've seen the company's profits fall by nearly 10%. Maybe that explains the weakness in the stock. We'll touch base with the management to find out the outlook for the second half of the year. Welcome back. Teamlease is the company on our radar. The stock is down 5%. Now, on a year-on-year basis, the company's revenues are up 23%, but profits have declined 10% year-on-year on account of a drop in margins. Though on a sequential basis, there is a pickup in revenue, 8.5%, a marginal expansion in the company's margins too. It's the general staffing and the HR business which has done well for the company, while the specialized staffing, high-margin IT hiring that the company does has been under pressure. Ramani Datti, CFO of the company, is now with us on the show. Thank you very much, ma'am, for joining in. This is Reema here. First, if you could tell us this quarter's numbers, 8.5% QOQ, 23% on a year-on-year basis. Was there an element of festive-related hiring? And will Q3 be as strong as Q2 or even better on account of the festival-related pickup that we typically see in hiring?
Thank you, Reema. So this quarter, the festive-specific hiring would be very minimal. It's about 2,000 to 3,000 because now we are catering to across the spectrum, including manufacturing, pharma, and other emerging sectors. So the portfolio is much wider compared to the prior years where we used to have almost 20-30% contribution during these festive quarters, coming from especially the festive-specific hirings. So whereas now we have been steadily doing about 15,000 of quarterly net headcount addition in our staffing business, this quarter specifically a 2,000-3,000 is specific to the festive requirement. Otherwise, for the quarter, we did about 18,000 net headcount addition. For the first half of this year, we did about 31,000. And on a year-on-year basis, almost 48,000 is the net headcount addition we did. This quarter, as well as Q3, the outlook for BFSI is a little below our expectation, especially in the sales profiles. Within BFSI, there are certain restrictions issued by RBI. That has impacted the BFSI growth for Q2, and it will continue for Q3 as well. Barring that, across all other sectors, we are expecting at least 18 to 20% year-on-year growth.
Okay. Ramani, let's talk about specific segments then, because there's a marginal uptick in margins for general staffing. It's 1.1% versus 1% sequentially, but it is lower than what you had seen earlier. Earlier, it was around 1.2 to 1.3%. This was few quarters back. Do you go back to these margin levels? What is the outlook for margins in general staffing?
Yeah. No, we'll be consistently expanding our margins as well because Q1 we had taken a huge hit in releasing all the NEEM trainees under our apprenticeship business. So that has an overall annualized impact of 20 crore on our profits. So we have already hit our rock bottom in Q1. So from here onwards, there'll be a consistent improvement in absolute profits as well as margins for staffing business. Converting that into specific basis points is a little difficult for us given the nature of our business, depending on what salary levels we hire the associates, that kind of impacts the margin profiles. But on absolute profits, we are confident that we can post strong double-digit growth sequentially.
So, Ramni, the only sector where you are seeing weakness is BFSI-related hiring on account of RBI restriction. How much does it contribute, this particular sector, to your overall revenues? Because even after this, you've still recorded a 24% jump in your generalized staffing top line. So just wanted to understand the impact of particularly this BFSI-related headwind.
Yeah, we have about 20% of our revenue coming from BFSI sectors, and Q2 BFSI for us is muted. But Q3, we are expecting that there'll be a slight drop in our BFSI headcount on account of these RBI restrictions. However, on a net level, we are still confident of posting a positive headcount growth in staffing as well as our DA business in Q3.
Okay, 20% of generalized staffing comes from BFSI, right?
That's right.
But and how much lower was BFSI, if I may ask, in Q2? And what will be the extent of rebound in Q3?
In Q2, we had a muted growth from BFSI. So the entire net addition that we did in Q2 has come mainly from consumer, retail, telecom, manufacturing, and other emerging sectors. And Q3, we are expecting a slight dip in BFSI.
Okay. You are expecting slight dip in BFSI in Q3, but Q4, so it should see some rebound according to you. You have been talking about enhancing your HR tech portfolio. First up, how big is it? And you've been looking at M&A discussions being in the pipeline as well. Anything that is finalized, something that we can hear about in this calendar year or maybe this financial year?
Yeah. In our HR services, we have mainly three businesses. EdTech, which is close to about 100 crore in revenue, consistently been profitable. So that business will continue to grow at a 25 to 30% year-on-year growth, both on revenues as well as profits. We have a RegTech business wherein we offer compliance services. That is about 50 crore in revenue and about, again, 6 to 8% operating profit margin. So that business will also continue to grow at 20-25% growth rate. The third segment, which is the HR tech services, we believe that business has larger potential for cross-selling opportunities with our staffing business and degree apprenticeship business. So in that business, currently, organically, we are doing close to about 20 crore revenue, but this is the segment where we are looking for active M&A opportunities. Either Q3 or Q4, we are hoping that we should be able to close at least 1 or 2 deals to expand our portfolio of product offerings in HR tech solutions.
Okay, and this is different from the higher tech platform which the company is investing in, which will go live in FY26, or it's the same?
No, it's different because higher tech is an organic investment that we are trying to develop.
So tell us a little bit more about higher tech.
Yeah. So Hightech is a technology platform which we are developing especially to boost the hiring engine in our staffing and specialized staffing businesses, because in any given month in staffing business, we are hiring close to 8,000 new headcount. And in specialized staffing, we are doing about 500 new hirings. Almost 40% of our direct expenses go into the recruitment related costs. So we are trying to optimize those costs, which are, again, growing linearly in line with revenue growth. And if we can increase our recruiter productivity, our matching engine, so then it can accelerate our revenue growth as well as optimize our costs, leading to margin expansion, further margin expansion. So this investment will take closely about 20 crore overall, spread over 18 months. And we are expecting this project to go live next year.
Okay. All right, Ramni, thank you so much for joining in today with those insights and what the business is looking like, especially what the outlook is going forward as well. That's the word coming in from Teamlease. The stock has recovered sharply from the lows, but still down around 5%. We'll do one thing. We'll slip into a short break for now. When we return, we'll discuss market technicals with Soni Patnaik from JM Financial Services and also discuss the top trading bets. Welcome back. You're still tuned into Trading Hour. While the broader markets, in terms of the index, is not doing so well, we have stock-specific action. Avalon Tech, for instance, it is in focus on the back of Q2 numbers. Upasna is joining in with the details. The stock is up at 12%. How did the numbers look, Upasna?
Well, Sonal, company has reported a strong set of numbers this time around, and the numbers were up. All the three, that is revenue, EBITDA margin and PAT, beats the street estimates. Now, domestic revenue growth is expected to drive sales of the company, and in the domestic business, mind you that the company has expanded into new areas such as solar and servers. Now, coming to the numbers first, the revenue stood at 275 crores with an uptick of 37% on a YoY basis, and EBITDA margin also expanded by 470 basis points at 10.9%, while the street was working with a number close to around 6.5%. Now, PAT stood around 17 crore with an uptick of 1.4 times, and order book also showed a growth of 19.4% on a YoY basis. Now, company has highlighted that it has started operations of a new plant mainly for the export, and company stands out as a EMS landscape as the only player with a significant manufacturing presence in the US markets. Now, let us understand what is happening in the company. Now, the company is on its recovery path for its US business, along with continued growth in its domestic operations. Mind you, in FY24, company's revenue was down about 16% on a YoY basis. This was mainly due to the losses seen in its US business. But now company is taking various strategic initiatives to recover the US business, and it is witnessing a recovery with a shift in stance from destocking to restocking. With this stance, company believes that the order inflow is expected to improve going forward. So all in all, strong set of numbers from Avalon Tech, and we can clearly see the stock surging in trade today.
And maybe there's an element of even Trump coming back to power, focusing on manufacturing. As she pointed out, it's the only EMS company which has a manufacturing presence in the US. So maybe there is that angle to it, apart from the strong numbers. Soni Patnaik from JM Financial Services now with us on the show for a quick tech check on the markets. Soni, quite the down day. How would you approach it?
Hi, good morning, Reema and Sonal. Thank you so much for having me on the show. I think today is just an expiry move. Yesterday, we did see Nifty test its hurdle of 24,500, did not sustain above it. But on expected lines, the expiry move has shown some sort of volatility today. On closing basis of 24,200 is defended for today. There's a more possibility that it can head again towards 24,500, 550 odd level. Any short covering in Nifty can only be seen above the resistance of 24,550, and on a positional basis, the short covering can get tested towards 24,800. Similarly, for Bank Nifty, I think 51,500 is acting as a strong support for intraday. If that holds, Bank Nifty can again retest the highs of 52,500 to 53,000 of a range. I think both the indices is looking fine. It's just an expiry volatility, and one can continue to remain hedged when it comes to indices.
Okay, and what would your individual technical picks be, Soni?
So I'll have both on the buy side. So the first buy would be in Sun TV, which is looking a good reversal from lower support of 730 odd levels. One can buy in Sun TV futures around 750, keeping a stop loss of 730 and a target of 780 to 800 can be seen on a positional basis. The second buy pick would be in Navin Fluorine, which has seen very aggressive longs today, and it's looking very strong above a 200 EMA. So one can buy Navin Fluorine futures, around 3570, 3580 range, keeping a stop loss of 3500 and a target of 3700 to 3730 can be seen.
Thank you very much for that. But let's get to Hindalco. That is the top Nifty loser. Stock is down 8.5%. After Novelis brought down their guidance, sounded muted. Nigel is here with the details.
Well, that's right. Hindalco is under pressure because of Novelis's numbers. And Novelis's numbers clearly were very, very disappointing. So if you look at the sales number, well, that was up by close to around 5% odd. But the EBITDA number, adjusted EBITDA, was down by close to around 5%. Keep in mind, this adjusted EBITDA includes a $25 million impact because of the flooding in the Switzerland plant. The problem was on the EBITDA per ton. And the adjusted EBITDA per ton is at around $489 per ton. But X of this flooding impact in Switzerland, well, that number actually is $502 per ton, which is still lower than what the street was working with. Now, the problem is the commentary on scrap. Hindalco, remember, they use a lot of their raw material, which is aluminium scrap, in the Novelis business. And they're saying that China has started buying a high amount of scrap, which is pushing the scrap prices higher. Because scrap prices are moving higher, it's putting pressure on their spreads. And because of that, now they've withdrawn that guidance that they'd given earlier on the EBITDA per ton. Earlier, they were guiding for EBITDA per ton of around $525 per ton. Now, in the near term, they're not giving any clarity on that front, which is the problem. And that's the factor that has spooked the street. In addition to that, the debt number as well has moved up marginally because of the higher capex as well as working capital. So the numbers were disappointing the past quarter, but the street is spooked because they have withdrawn this EBITDA per ton guidance of $525 per ton. Back to you.
Okay, all right. Thank you so much, Nigel, for getting us all those details. That's a big cut on a Nifty stock. We'll slip into a short break now. When we come back, we'll get to more on the markets and stock-specific action on the other side. Stay tuned. Welcome back. You're still tuned into Trading Hour, where we've been talking about stock-specific moves, and Gujarat Gas is one of them. Now, remember, this is the last of the city gas distribution companies to report numbers, and it has been doing well since the time it reported numbers as well. It was a margin beat, but a volume miss. That's how you can summarize these numbers. If we compare it with the poll, the revenues are slightly lower, but the margins have been much better. EBITDA has come in around 60 crores higher than the poll. We have the margins which have come in 200 basis points higher than the poll at 13.6%, leading to a beat on profit as well. Sequentially, it was expected to be a weak quarter, and that continues because the revenues are down 15%, EBITDA is down 4%. Margins, however, are higher 160 basis points, but profits are down 6.7%. Now, let's talk about the volumes, because that's where a miss came. 8.75 MMSCMD, which compares with an estimate of 9.1. It's sharply lower on a quarter-on-quarter basis because of weakness that we saw in the Morbi volumes. This is because of subdued export market for ceramic industry. We saw the monsoon impact as well. There was unfavorable propane gas economics, and customers were also facing shipping issues because of global disturbances. So Morbi continues to be the weak point. At a point in time, that was the growth driver. Gross margins, however, improved both YOY and on a quarter-on-quarter basis to come in at 10.4 rupees, and EBITDA per SCM came in at 6.4 rupees. So the margin performance is something that the street seems to like, because despite the fact that gas costs went higher, the company was able to maintain margins. But yes, there was a miss on volumes, but the stock is higher by 4% in trade.
Okay, thank you very much for that. Apollo Hospitals has clocked in a very good quarter. Margins, profits ahead of street expectations. There was a jump in the company's occupancy levels. Occupancies in Q2 came in at 72-73% versus 68%. And the management said that occupancy should stay, 70% even in the second half of the year. Even the average revenue per bed, the RBOP level has, continues to inch up. So all in all, things are looking good. The stock is up 7%. Listen in to the management.
So currently occupancy is at 73%. I think we should, despite the festivities, look at around 70% for sure. Our POB currently grew only 3%. It's at 59,000, close to 60,000. But here again, you can expect to see an improvement of 45%. 24/7 has launched its insurance broking portal. And with this, with the connect that we create with this, we look forward to looking after communities. At this time, I have no plans that I can disclose, but we are watching the space very closely. Right now, that's not, getting into insurance right now is not something that we're looking at, but we do have an insurance broking license. And using all this effectively, we should be able to move in the right direction with regard to looking after people's health and making healthcare accessible to them.
Okay, let's move on and talk about the big earnings expected today, M&M, and that's a bit under pressure ahead of the Q2 numbers. Sudarshan joins in with the expectations. Sudarshan.
On the earnings front, we are expecting a strong set of earnings from Mahindra & Mahindra for quarter ending September, and it's going to be led by the auto segment. But first, we talk about the stock performance. It's up 70% in 2024 and up nearly 3% this week, but still almost 10% away from the record high that it had hit on September 27. Coming to the main numbers expectations, profit is seen flat at rupees 3,405 crore. Revenue may see double-digit growth aided by healthy auto volumes. Overall volumes in Q2 are up 7% YOY, with auto volumes increasing by 9% and tractor by almost 4%. EBITDA is expected to increase by 22% and margin may see an expansion of more than 100 basis points. Some of the internals that may be watched out for: first, mix within the auto segment will be watched very closely with an increasing contribution of SUVs. Second, we may see a revenue share from the tractor segment or farm segment. The revenue share may come down, revenue share that we see from tractor to the overall volume. So that may see a fall. So on the earnings front, we are expecting a healthy set, but all the eyes will be on the demand outlook that the company might give post earnings.
Okay, yes, and we'll keep coming back to you for more analysis on this. Numbers are expected during market hours because there's a presser at 1:30 p.m. We'll do one thing. We'll take a short break now. When we come back, we'll get you more on the markets, and we'll also get the details of the new insurance, which is the new IPO that is opening. That's Niva Bupa Health. We'll get you the details on the other side.
Welcome back. Let's turn our attention now to the primary market. Niva Bupa Health Insurance's 2,200 crore IPO opens for subscription today. Yash joins in with the details and a quick peer comparison.
Well, Rima, after a gap of about 3 years, and even then, only the second health insurer's IPO opens today. Niva Bupa's health insurance plans to raise about 2,200 crore through its IPO, out of which 800 crore is through a fresh issue for itself. The price band for the issue is between 70 to 74 rupees per share, and at the upper end of the price band, Niva Bupa is expected to have a market capitalization of about 12,580 crore rupees. Now, interestingly, the 800 crore raised by Niva Bupa will take its solvency, which is already at a very strong point of 2.39 times to over 3 times. The company says that the fundraising is ahead of time to be sufficiently capitalized for an anticipated strong growth which it sees ahead of itself. There is already a listed player in the standalone health insurance space, that is Star Health Insurance. Star Health is much bigger in terms of size of business as compared to Niva Bupa. But here's a quick comparison when it comes to the size of business. Niva Bupa collected about 3,800 crore rupees in FY24 in net earned premium, whereas Star Health was over 3.5 times bigger at nearly 13,000 crore rupees. Niva Bupa made an underwriting loss of about 410 crore rupees, whereas Star Health stood with an underwriting profit of about 90 crore rupees. Niva Bupa's operating profit was at 188 crore. Star Health was nearly 4 times bigger at 731 crore rupees. Star Health's combined ratio is better by about 200 basis points as compared to Niva Bupa. And finally, Niva Bupa's net profit of 82 crore rupees in FY24 was 10 times smaller than that of Star Health Insurance. In terms of market share, Niva Bupa's market share amongst general insurers was 2%, and among standalone health insurance companies was about 17%, whereas Star Health's market share was 5% and 46% in the same two categories. But the smaller size has been bringing much stronger growth for Niva Bupa Health Insurance. Niva Bupa's net earned premium, that grew by 43% versus Star's growth of about 18%. Niva Bupa's underwriting loss reduced by 20%, whereas Star's underwriting profit, that came down by about 1.3 times. Niva Bupa's combined ratio, that increased by about 154 basis points, and Star's as well increased by about 134 basis points. Most interesting one, Niva Bupa's market share amongst general insurers, that grew by about 35 basis points versus a growth of 22 basis points for Star Health Insurance. But the interesting story is amongst the standalone health insurance companies. Niva Bupa's market share, that grew by 141 basis points, whereas Star Health declined by about 330 basis points. So growth certainly in favor of Niva Bupa, but size in favor of Star Health. What does that do to the valuations? Niva Bupa is coming with a valuation of 6.13 times pre-money and 4.72 times post-money price to book. Star Health trades at the same valuation of 4.73 times price to book value.
Thank you. Interesting comparison. Well explained. Thank you for that. With that, it's a wrap on Trading Hour from the entire team. Thank you for watching.